Good day, Iggy. Today, I'm excited to chat about the Straits Times Index hitting a string of new all-time highs, recently closing at 4.7. That's a powerful run, and plenty of people are asking, is it still safe to invest? Or are we at the top?
Hi, Ivana. Happy to dive in. For those who don't know me, I'm Iggy, founder of the Investing Iguana. We break down stocks, finance tips, CPF, and explain what's driving our market in simple terms. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We just crossed the 1 million mark for number of reads and 60,000 likes. I've produced over 1,000 videos with more than 600,000 watch hours as of August 2025. I also focus on regional and global economic trends, so this topic is right up our alley. And about the STI at all-time highs, this move is real. Last week alone, the index hit 4 fresh highs, closing July at 4,273, and it's up more than 20% from its lows in April.
Why is an all-time high assigned to sell? Some think the only way is down from here.
Imagine a football match. Your team keeps scoring, but that doesn't mean they'll suddenly lose. The STI's rise ties to real drivers, not just hype. Over half the index comes from our banks, DBS, OCBC, and UOB. Their results have stayed robust, even with interest rates starting to edge down. It's not unusual for markets to go higher after hitting records, and in fact, pulling out at highs is how you miss compounding gains. So long as fundamentals hold, new highs aren't a red flag.
So let's talk banks. DBS hit an all-time high of 46.9 this July, right? What's behind that, and how are the other banks doing?
Exactly. DBS hit a record at 46.99, and the other two, OCBC and UOB, are also near peaks. OCBC closed at 17.33p, UOB at $37. The drivers, resilient interest margins, solid fee income, and Singapore's stable economic picture. Even with modest earnings growth now compared to the past few years, these banks continue to deliver high dividend yields, about 5% to 6.4% this year, easily topping most other developed markets.
Is that dividend yield really that special in 25?
It's outstanding. Data as of July 2025 shows most blue chip stocks in Singapore still offer 5% or more, outpacing the 10-year Singapore government bond, which dipped to around 2.2% recently. While bond yields squeezed up last year, the spread has narrowed again. For income-focused investors, Singapore is still one of the best places for steady dividends, especially if you prioritize stability.
I keep reading about safe haven flows. Why is Singapore so attractive compared to other markets this year?
2 things: stability and yield. Around the world, investors are wary. Geopolitics, US-China tensions, volatility in China and Europe. So they flock to places where politics are stable, currency is robust, and companies are well managed. Singapore checks every box. Even foreign analysts have named our stock market #1 for defensive qualities in Asia this summer.
But what could go wrong? Any risks we should highlight?
Always. Markets never go up in a straight line. Right now, risks include the usual suspects: tariffs, global slowdowns, or weaker than expected local bank earnings. With the monetary authority of Singapore's new $5 billion equity market development drive, there's also been a lot of money moving into small and mid-cap stocks. These can swing more than the heavyweights. Think of it as an MRT train packed after a rally. There may be stops and shakeups before we see who stays on.
And yet, experts are saying STI could go even higher?
Yes, both Morgan Stanley and JP Morgan recently raised their targets. JP Morgan now points to 4,500 as base and 5,000 for bull case by next year, provided we don't get hit by a sharp global recession. They also stress Singapore stocks aren't expensive. The current price/earnings ratio is about 14.8, just above the 5-year average, so valuations are not stretched. Long term, with continued solid earnings and strong dividends, the outlook stays positive.
Practically speaking, if someone wants to invest now, should they wait or wait in?
For the long-term investor, history shows buying at highs isn't a bad move if you spread your risk. The bus may be rolling, but as long as you're patient and focused on your goals, you'll get to your destination, even if there are some bumps. The winning move is to avoid betting everything at once. That's why dollar cost averaging, investing a set amount monthly, works so well.
And diversification?
Absolutely critical. Don't load up only on Singapore. Some diversification into tech, global ETFs, and even REITs for property exposure helps soften ups and downs. Pick companies with resilient cash flows, so even if prices dip, you still get paid while you wait for recovery.
You referenced a lot of numbers, charts. Where can keen viewers see your supporting analysis in detail?
All this data and plenty more is broken down on our Substack site. That's where the in-depth tables, sector breakdowns, and yield trackers are posted up for subscribers. If you want the background math, it's all there.
Perfect. Listeners, if you love digging into the numbers, check out the Investing Iguana on Substack.
Thanks for the plug, Ivana.
So, big question. If you had to sum it up, what's your gut take for Singapore investors who are watching these record highs?
Here it is. Don't let new highs shake your confidence. Singapore's big banks, steady dividends, and defensive profile still make it a strong pick. But stay realistic. There could be volatility if global news turns. Diversify. Consider dollar cost averaging. Avoid timing trades and invest with your long-term plan in mind. No investment is bulletproof, but the odds here remain favorable for the patient and educated investor.
That's a comprehensive summary. Singapore's STI is strong, but risks remain, and wise investing means diversifying, patience, and ignoring day-to-day headlines.
Couldn't have said it better myself. And remember, anyone wanting the full statistics and updates, the Substack is open.
Iggy, everything you shared has been so helpful. Before we sign off, what's the fastest way for keen investors to get ahead with the Investing Iguana community?
Glad you asked. If you want premium access, our paid subscribers get all our new videos a week early, along with written analysis and urgent commentary straight to their inbox. It's just $1 a month, cheaper than your copy. It's your early advantage and daily dose of straight talk. If that sounds like your thing, check the link in the description below and join us as a premium member.
Brilliant. Thank you again, Iggy, for your practical and honest advice. Can't wait for our next session.